Good day and welcome to the Indigo Paints Q3 FY2024 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manoj Menon from ICICI Securities. Thank you and over to you, sir.
Hi everyone. As always, it's our absolute pleasure at ICICI to host the results conference call of Indigo Paints. Today morning we have Mr. Hemant Jalan, Chairman and Managing Director from the company, Mr. Suresh Babu, Chief Operating Officer, Mr. Chetan Humane, Chief Financial Officer, and Mr. Srihari Shantakumar, General Manager, Finance and Investor Relations. Without much ado, over to the management for opening remarks and post which we will open the floor for Q&A. Thank you.
Thanks, Manoj. Thanks everyone for joining the conference call today. As mentioned before, today to discuss the results, we have with us Mr. Hemant Jalan, Mr. Suresh Babu, and myself, Srihari. We have already uploaded the financial results and the investor presentations along with the disclaimer on the websites of the company as well as on the stock exchanges. Hope you have a chance to go through them. Request Mr. Jalan to give an overview of the performance followed by the Q&A.
Thanks, Srihari. Thanks, Manoj. And thank you all for joining in on the earnings call of Indigo Paints for the third quarter FY24. We are happy to report yet another quarter of industry-leading growth. It's the third quarter in which Indigo Paints has grown by 3 to 4x times the industry growth rate, indicating consistent market share gain by the company. The growth in sales was accompanied by an equally good growth in the profitability metrics as well. Now we'll first look at the performance of the company on a standalone basis, followed by the results on a consolidated basis. First, the standalone. Compared to Q3 of last year, our sales in Q3 of FY24 have registered a value growth of 21.33%, which is once again almost 4x of the industry growth this quarter. Our gross margin of 48.43% in Q3 of FY24 is significantly higher than the gross margin of 43.82% on a Y-on-Y basis, and we continue to maintain the leadership position within the industry in terms of gross margins for the last 14 to 15 quarters in succession. EBITDA has increased by an impressive 50.18% from a figure of 40.56 crores in Q3 of last year to rupees 60.91 crores in Q3 of this year. The EBITDA margin of 17.85% clocked in this quarter has also expanded from 14.42% registered in the comparable period of last year. The PAT has increased by a robust 43.55% to 37.70 crores compared to 26.26 crores clocked in the same quarter last year. And this expansion of PAT is despite the depreciation load on the company increasing by over 52% on account of the new plant at Tamil Nadu coming on stream. The PAT margin for this quarter has expanded to 10.96% compared to 9.21% in the same quarter last year. Details of our 9-month standalone results have been elaborated upon in our investor presentation, and for the sake of brevity, I shall not repeat them here. Suffice to say that this is the third consecutive quarter when we have outstripped the top-line growth of the industry by a factor of around 4x, and this is amply reflected in the 9-month cumulative figures when you compare them with our peers. Now coming to the consolidated results. For this quarter, our revenue grew by 25.78% to 353.77 crores, while the EBITDA grew by 53.46% and the PAT grew by 42.98%. The EBITDA margin on consolidated basis was 17.59% and the PAT margin was at 10.52%. The sales traction has picked up at our subsidiary Apple Chemie, and we have started getting new orders from states outside Maharashtra as a consequence of the expansion of Apple Chemie's selling territory. On a consolidated basis, our outperformance on top line growth is about 5x of that of the industry. We expect even better growth from Apple Chemie in the ensuing quarters as they further ramp up their sales force in regions across India. The detailed 9-month consolidated results have also been uploaded in the investor presentations, and once again I shall refrain from repeating all the numbers here. I'd like to now give you some operational details about the last quarter, going beyond the simple financial numbers. Now, during the last quarter, the overall advertising and promotion spends increased by almost 26% to rupees 32.53 crores, primarily due to the advertisements that we aired during the World Cup cricket series and the seasonally high spends which generally occur in the months running up to Diwali. However, we are well within our annual advertisement budget, and although our A&P spends will increase every year, we expect the spends as a percentage of revenue to decrease on an annual basis by about 150 basis points. Despite the significant increase in A&P spend this quarter, I would like to highlight that the EBITDA margins have substantially expanded this quarter, indicating gains A, due to operating leverage, and B, due to better gross margins. And we expect the EBITDA margins to improve further in the upcoming quarter. We have also recently launched a new advertising campaign to promote waterproofing products in our retail range, which has been very well received by the audience. Now, in line with our consistent disclosure practices, we have given our volume and value growth numbers for each of the 4 major categories of paint products. During the quarter, the company witnessed very, very healthy double-digit volume growth across all product categories, and the value growths have been pretty similar and largely in sync with the volume growths, as you would expect for a year where there have been no significant price changes. The value growth in the emulsion category of 18.2% has been particularly healthy and outstrips the volume growth of 14.3% in the same category, which is a clear indication of the gradual premiumization in our emulsion sales. We continue to focus on network expansion, improving the throughput per active dealer, and increase our tinting machine population. As on 31st December 2023, our count of active dealers stands at 17,745, and the tinting machine population stands at 9,510. The throughput per dealer, if you do the simple math, has gone up significantly in the last 1 year. During the quarter, we also opened 2 more depots, one in North India and one in Eastern India, to increase our distribution efficiency. On the capex front, civil works are progressing well in the new water-based plant being set up at Jodhpur, and orders for most major items of plant and machinery have already been placed. The plant is expected to commence operation by the end of FY25. Work is also expected to start very soon on the proposed solvent-based paint plant at Jodhpur. As mentioned in our previous call, to focus on waterproofing and construction chemical products, we have already set up a separate team in all depots to exclusively work with the channel partners and influencers to promote these products. Along with this, as mentioned a short while ago, we have also launched a new advertising campaign for the waterproofing products. We have witnessed an excellent boost in sales for these products in the month of January, which is typically the start of the season for sale of waterproofing products. We are hopeful that this segment will make a very meaningful contribution to our top line in the ensuing quarters. Similarly, we have also entered the segment of project sales by setting up a separate team in select depots to cater to paint demand in the institutional sector, mainly of large new constructions happening across India. However, this is a segment which has a longer lead time gestation period, and it will probably take several quarters before this segment starts contributing meaningfully to the top line. But it is a vital segment in the paint sector and something in which we need to invest our efforts in. With 3 quarters of consistent industry-leading growth, we are quite confident of the strategic path we have taken to put the company on a supernormal growth trajectory. With our differentiated products portfolio, our pivots like focus on Tier 1 and Tier 2 cities, enhanced engagement with influencers, foray into waterproofing and construction chemicals, foray into project sales, and the infrastructure play through our subsidiary Apple Chemie, we expect this industry-leading performance to continue despite the competitive environment. Finally, if you study the sales trajectory of our company over the last 3 years, you will notice that in our case, the fourth quarter is the quarter of highest sales, highest gross margin, highest EBITDA margins amongst all the 4 quarters of the fiscal year. This year will be no different, and we expect significantly higher sales numbers in Q4, accompanied by very good bottom line figures. That's all I have to say as an opening remark, and I look forward to receiving your questions. Thank you.
Sure, thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from Mihir Shah from Nomura. Please go ahead.
Hi, sir. Thank you for taking my questions, and congrats on a very good set of numbers. So firstly, on volume growth and market share, volume growth has been super strong across subcategories. So firstly, on market share, whom should we attribute most of these share gains from? Clearly, it is coming from both organized and maybe unorganized as well, and as we can see it in the results. But, from your side, would you say you are gaining more from organized players or unorganized players?
I think it is mainly from the organized players who are the dominant, category holders as far as the paint sector is concerned. When we compare our value growth with the value growth of other organized players who are our larger peers in the industry, and if we outperform them in growth, it is very simple that substantial growth in market share is coming at the expense of others. Now, it would be very marginal pickup from the 4 other larger players. So we probably don't disturb their growth plans in isolation because we are still relatively small to at least the 2 or 3 larger players in the industry. So they may not feel the pinch, but of course our market share does grow at their expense. Whether some of the growth comes at the expense of the unorganized player is really hard to measure because no accurate data is available on what the growth of the unorganized sector has been in the same period. But I would largely attribute it to growth at the expense of the larger players.
Got it. No, I was just asking because your consumer will largely be choosing from the organized, palette versus the unorganized products that are there. So I also was thinking of the same. So supplementary to this, can this be disproportionately higher sales be attributed to any regional skew or across regions you are seeing similar growth?
I think it is pretty similar across pan-India. I don't think there is a particular regional skew to this growth. I think overall, if there is one region which has perhaps grown a little faster than all the other regions, it is perhaps the northern part of India. But otherwise, we have had fairly good growth coming across all regions as far as the last quarter is concerned.
Got it. So my second question is on pricing. I believe you would have also taken some price cuts along with industry. Please correct me if I'm wrong here. And how should one think about pricing going forward? As are more price cuts likely? Because we don't see gross margins significantly higher than historical averages. It's not like a material difference. And raw material prices are also pretty much range bound, of course, with some volatility also being there. So would you expect more price cuts to continue, or do you think that these are sufficient enough?
See, that's a question that is best put to the industry leader because all price changes are initiated by the industry leader. Now, you're right that a price drop has happened in the middle of January, and that is in Q4, and that has happened on select premium range products. Now, fortunately or unfortunately, our share of sale in the premium range is somewhat less than the larger players in the industry. So to that extent, we are perhaps a little less impacted by this price decrease. But what happens is that whenever there is a price decrease, one notices a corresponding decrease also in the incentives offered to the trade in those same categories. May not be exactly to the extent of the price drop, but at least 60-70% of that does get covered by reduced schemes as far as the trade is concerned. Now, I do not know what has prompted the industry leader to lower the prices substantially for those segments in view of the fact that raw material prices have relatively remained stable over the last 6-8 months. That's a question that you'll have to answer them. And whether they are contemplating any further price cuts in some other segments is also a question that I'm not in a position to answer. You'll have to ask that question to the industry leader. But one is not overtly worried about these things because a large portion of any price cut, if and when it happens, does get covered by slightly reduced incentives and margins to the trade in terms of discounts. So it's not a point of very great concern. And I don't think that EBITDA numbers would be very significantly affected even for the larger players in Q4 and certainly not for us because our exposure to that segment is somewhat smaller.
Got it, sir. So lastly on gross margins, I understand the math that you explained on EBITDA margins. But how should one think about the industry-leading gross margins that you command at this point of time over the medium term? Clearly there is also a tailwind of mix improvement with waterproofing products, etc. Would you think that what is the kind of headroom that you see in gross margin improvement over the medium term?
I don't think there's much more headroom left for gross margin expansion beyond this. It may fluctuate by half or 1 percentage point in either direction as we go forward. Of course, Q4 is usually the quarter where we get the highest gross margin. Now, our gross margins have outpaced even the industry leader for the last 3 to 4 years consistently in every quarter. A large portion of that has to do with our differentiated product portfolio, which contributes over 30% of our sales, where our gross margin contribution is very high because we kind of own that space. And sales of most of those differentiated products, due to weather reasons, climate reasons, reach their peak in Q4, because Q4 is the one quarter where you do not have any rain whatsoever, and all stars are so-called aligned to promote painting activities in India, and therefore in Q4 every year, if you'll notice, our sales are high, our gross margins are the highest, our EBITDA margins are the highest. So at the end of 9 months, our EBITDA is around 17% or something. And, we'd expect a substantially higher EBITDA in Q4. So we do expect to close the year with a year-round EBITDA margin of somewhere in the range of 18.5%. And that is pretty much the guidance that we had given a year ago, and we stand by that.
Perfect. That's wonderful, sir. Thank you very much. Wishing you all the best. And that's all from my side.
Thanks.
Thank you. The next question is from the line of Jay Doshi from Kotak. Please go ahead.
Hi. Good morning. Congratulations on good results. I have a couple of questions. The first one is with respect to just a clarification on your comments on the TV interview today. Did you mention that you are targeting 2,000 crore sales next year, FY25?
I'm saying that in this particular year, when we end at the pace at which we are growing, we expect to end somewhere around 1,350 to 1,400 crores. Now, our outpacing of the rest of the industry is kind of widening with every successive quarters for the last 3 quarters. If we continue on that trend, which we hope to do, then 2,000 crores, as I mentioned, would be a stretch target to aim at. I also clarified that we may fall a little shy of that, but that is the range at which we would attempt to achieve as far as next year is concerned. In fact, we would be disappointed if we did not do that. But of course, having said that, I have no means of predicting as to what the industry growth would be next year, whether it would climb up back to 8 to 10% or go higher than that or be a little lower than that. So to that extent, of course, we keep our fingers crossed.
Understood. Second is, I heard you, in opening remarks mention that you are targeting 150 basis point savings from A&P spend as percentage of sales.
Yes.
Does that apply to FY25 as well?
Yeah, I think it will more or less apply to FY25 also. And at the end of FY25, we will take a call as to whether we start once again ramping up. I mean, if that happens, if FY25 also we maintain more or less the same ad spends with a minor maybe 5% increase, and the top line increases by whatever, 25, 30, 35, 40% growth, then I think the A&P spends by the end of FY25 would reach a level where we will have to think going forward as to whether we start ramping up the A&P spends by a slightly higher amount. And, if that happens, then in FY25, we should be looking at an EBITDA margin of close to 20%, which would be very healthy. And we'll have to take a call as to where to invest the extra surplus available. A&P is one avenue to spend that money. There are many other levers that you can pull, which have to work in tandem. I think our advertising salience has reached a fairly high level, and the brand is very noticeable, identifiable, And at this point in time, we don't think much benefit accrues from a substantial escalation in A&P spends.
Understood. The reason for asking that question was because all your peers are, indicating increase in A&P spends in view of the new competition that's coming in. So, just wanted to clarify on that one.
Small correction, Jay. I have heard peers talking about slight increase in A&P spends, but I have not heard anyone saying that it is as a consequence of a new entrant coming in. So I think it is a fairly independent activity, and I significantly doubt whether any of that is as a consequence of any new entrant's proposed entry.
But
that is a surmise that you are free to take.
I mentioned increase in terms of percentage of sales, A&P spend as percentage of sales.
No, even as a percentage, I'm saying whether it is a consequence of some new entrant coming or an independent action is something that I'm not very sure of.
Understood. All right. Thank you so much and good luck for 4Q.
Thanks.
Thank you. The next question is from Lakshmi Narayan KG from Tunga Investments. Please go ahead.
Yes, thank you. So two things. One is the Concall plant, which is 50 KLPA, and the Jodhpur plant. When would it be coming on stream?
The Tamil Nadu plant is already on stream. It went on stream in mid-September.
Okay.
It is running fairly well, and we are well past the teething stage of that plant, and it is in very smooth production. In Jodhpur, I've mentioned that we expect the plant to come on stream towards the end of the next fiscal. So we are targeting March 25 as a date to commission that plant. We are some distance away from it, so that target could move by 1 or 2 months in either direction. It's not very critical because all these capexes are done with a slightly long-term view in mind, and it would not impact our sales in any way if the plant does get commissioned a little earlier or a little later. But that is with a long-term view that we are doing all that.
Got it. So with excluding the Apple one, what is the total capacity right now?
See, the capacity has to be measured across various different kinds of paints, because different kinds of paints use different kinds of equipments. Mm-hmm. So there is a particular capacity for making putty, for example, which is roughly about 10 to 11,000 tons per month. So that will translate into roughly 125,000 tons per year. Then there is a cement paint where the monthly capacity is somewhere in the region of about 1,200 tons per month, and that is more than adequate because that is not a segment that grows very fast. There is a separate category for solvent-based paints where our current capacity is about 13,400 kiloliters per annum. At the moment, only in Tamil Nadu. We are starting work on setting up a similar capacity plant at Jodhpur of about 12,000 KL per annum. When we come to the largest category, which is the water-based paints, our total capacity at the moment at Cochin is about 42,000 KL per annum. At Pudukkottai, that is Tamil Nadu, where we have set up, it will be somewhere in the region of about 55,000 KL per annum. At Jodhpur, the present capacity is 54,000 KL per annum, and that, with the new project that we are setting up, will go up to 90,000 KL per annum. So that new project at Jodhpur is a combination of capacity increase and complete modernization of the existing facilities and automation. So, capacity in the paint sector, just like volume growths, are meaningless when they are just added up arithmetically. You have to look at them from each category of paints and come up with multiple capacities for different lines of products.
Mm-hmm. So, what is your broad sales mix across regions?
Pardon?
Your sales mix across regions?
Sales mix in what unit would you want them?
No, I just want to understand from your total revenues, how much would come from the southern markets, how much would be from...
That is a kind of information that we would be reluctant to share at a great level of detail. But I would say that because of our disproportionate presence in Kerala, I mean, South does contribute more than, significantly more than 25% if you look at the geographical split of 25% at each place. Pretty good in East and pretty good in West. North is the region where we had made the kind of last entry into India, but that is also the region that is growing the fastest for us, perhaps because of the base effect. So pretty even across all the four parts of India, North, South, East, West, with minor differences, but I'd be a little shy of sharing very exact numbers as far as that.
Because some time back, you had mentioned that setting up these capacities would actually bring down your freight rates, which is around 9% or so for us right now. So I just want to understand what is the optimal distance you like to travel from your plant, and how these plants setting up would actually bring down your freight logistics costs.
Coming from that, you see, freight rates come down for two reasons. One is the proximity. So definitely a lot of regions in southern and part of eastern India also are now getting service from our Tamil Nadu factory for water-based paints, which were earlier serviced by Jodhpur. So for example, states like Tamil Nadu itself, Telangana, Andhra, Karnataka and Odisha, parts of Maharashtra, parts of Chhattisgarh, they are more economically serviced from our Tamil Nadu plant than Jodhpur. So those regions from the last quarter onwards have been serviced largely from our Tamil Nadu plant as opposed to being serviced by Jodhpur. And that does lead in some reduction as far as freight is concerned. When the solvent-based plant is set up at Jodhpur, which would also happen hopefully by March of 2025, then solvent-based paints in the entire northern and eastern parts of India will start getting service from Jodhpur instead of the whole country being serviced from Tamil Nadu as is happening now. So that will also bring down slight freight rates. But the greatest contribution to reduction in freight rates happens with the premiumization of your range.
Mm-hmm.
See, a premium range product, let us say it is selling at 400 rupees a liter, encounters the same freight as an economy range product which may be selling at 1/3 the price. So the freight expressed as a percentage of top line is highly dependent on the premiumization of your product mix. As the premiumization improves, the freight rate, all other things being constant, as a percentage of top line starts coming down. So those are the two forces that drive the freight cost, at least as far as primary and to some extent even secondary freight is concerned, the premiumization of your range and of course the distance from your factories.
Got it. The last question is that among your dealers, you have around 17,000 approximately dealers. How much would be, I mean, all of them are multi-brand, I guess, right? So what is
your voice is a little faint. Could you speak a little louder?
So I assume that all of them are multi-brand. So in general, in these places, what would be your share in the outlet? Would it be in excess of 50%, or how do you look at it?
You're right when you say that almost all of them are multi-brand. But if our share in those outlets across the country were more than 50%, then our turnover would have been 4x of what it is. So unfortunately, that is not the case. So the idea is to increase the throughput per dealer, as we have mentioned in our call. And let's say, on average, if our share of counter sale, and we have not done that exact mapping for dealers across the country. But let us say if it is 25%, then the challenge is to move that incrementally to 35% and then to 45%. And as you do that, even without any network expansion, you get very substantial increase as far as sales is concerned. So if you will notice in the last 1 or 2 years, the expansion in our network is happening, but it is happening at a slower pace than the actual increase in sales. Because a lot of that increase in sales is happening because of increased share of the counter sale.
Sorry.
And the thing that is more closely correlated with all that is increase in our tinting machine population. When the tinting machine population increases and as more and more of our dealers adopt our tinting machine, the throughput per counter for those counters which have tinting machine tends to go up very drastically.
Got it.
That is the number that we track more closely than simply the increase in the dealer count.
Got it. This is very helpful. Thank you.
Thank you.
Thank you. The next question is from Aditya Bhartiya from Investec. Please go ahead.
Hi, good morning, sir. The strategy of penetrating tier 1 and tier 2 markets appears to be playing out exceptionally well. And these are the areas wherein one would anticipate competition from larger guys to be a lot more intense. So what has really kind of contributed to it? And if I may just add to it, how would our pricing and dealer incentives be different versus, let's say, some of the larger guys?
I don't think there is any difference in either the pricing or the dealer incentives in larger cities versus smaller towns. All the dealers, whether they are in a large city or in a small town, and these dealers are all multi-brand, openly admit that the margin that they make by selling an Indigo product is significantly higher than the margin that they make selling by a larger brand on the same counter. And that is not a surprising piece of news to us. We have known that all along, and the dealer community also knows that. So I don't think giving higher incentives to that dealer results in anything at all. What is more important is to get the pull from the customer. And that pull from the customer is generated by working more intensely with the influencers, the painters and the painting contractors who generate the demand and make a recommendation for your brand. And that is an activity that is painstaking. It takes time. It takes a lot of effort. It does not consume a whole amount of capital in terms of money or investments, but it does take a lot of time and effort and patience for that to gradually happen. And as and when that happens, the dealer is already incentivized. He is already making more margin by selling Indigo versus some of our larger peers, and therefore no further incentive is required and is not very instrumental as far as driving sales is concerned.
Oh, that's very well explained, sir. That helps a lot. If we may look maybe a year and a half back, which was the time when we were struggling a bit to outpace our competition.
Yes.
Versus that, you had outlined a very clear strategy of penetrating larger towns and of working on the contractors and painters.
Yes.
Do you think it's only these things which have contributed to such a significant improvement in performance, or is there something else also that we should be aware about? What were the challenges that you saw maybe a year and a half back?
I would say that strategy that we laid out is largely what is responsible for the outpacing that you see now. So it is something that we realized. Maybe in hindsight we realized it a year later than when we should have realized it. But when we did realize it and made corrections in our sales strategy, in the number of salespeople that we had on the ground, in the number of below-the-line people that we have on the ground who talk and work with the influencers in the market, That is largely the reason for this outpacing of sales growth, which we have regained now. Now, there are other contributors also. For example, our foray into waterproofing chemicals, that contributes significantly now to the top line on our standalone company, Indigo Paints. And there is also meaningful contribution coming in from our subsidiary, Apple Chemie, which adds up as far as our consolidated results are concerned. So that's another thing that is propelling us. We are looking at entering into more areas. As I said, we have formed a separate vertical for project sales, although I would not be too optimistic about making huge gains in that space in the next fiscal. It will probably take at least a year and a half before that starts yielding meaningful contribution towards the top line. But the waterproofing is an easier space, and we have a natural affinity towards it. I think we have a very distinct product advantage in terms of quality. We are already supporting it aggressively with advertising, and I'm confident that the waterproofing segment will be one of our fastest growing segments going forward into the next fiscal.
And to add to that, we also have started our focus on adding wholesale dealers in most of the markets. We have a separate vertical now tracking that, and in fact, we have that vertical tracking for our key dealer to contribute to approximately 50% of our sales. So that has also substantially helped us add to the increasing pace of sales.
Perfect. That's very, very helpful. Thank you so much.
Thank you. Next question is from the line of Avi Mehta from Macquarie. Please go ahead.
Hi, sir. Am I audible, sir?
Yeah, you're audible. Please go ahead, Avi.
Sir, thanks a lot for this opportunity. Sir, I wanted to just understand the 4Q, your comment on sales growth in particular. See, you pointed to industry growth uptick required for us to reach that 35-40% sales growth target that we typically have. But if I look at your own target for FY24, it does suggest that your growth will move to, a similar kind of trajectory of 35-40%. You can just back calculate it. And this is despite the fact that other players are saying that Jan is weak. So I was just trying to kind of combine the two statements and kind of understand them. Does it mean that our growth now has become a lot more our own driven, and hence, this is more a conservative stance that you are taking right now for FY25? If you could help me understand how should I look at these two, statements that you made. Thank you very much, sir.
Avi, with 10 months gone in this fiscal, and for 9 months, our growth has been somewhere in the region of about 20%, 19% or something. On a consolidated basis, a little better. I think it would be difficult, although the fourth quarter accounts for a much higher share of our revenue compared to other players. It would be difficult to think beyond 25% growth for the entire year. At best, if we have a wonderful quarter this year, then on a consolidated basis, we could be talking about somewhere in the range of 25 to... on a consolidated basis, we are doing a lot better than on a standalone. So I don't know whether your question is aimed at the standalone results or the consolidated results. On consolidated basis, for 9 months, we have grown at over 23%. We'd be happy if that number goes up to 27, 28% or something. And that will lead us to, I think, somewhere around 1350 upwards as far as the sales for this year is concerned. Now, I don't think that our growth is independent of the industry. Yes, we do outperform them by a wide margin, but the underlying sentiment in the market does affect us all. So, if you...
sorry, sir. Maybe if I can clarify, sir, what I...
For the industry, when in Q2, I think, if I recall, the industry growth was around 2% or something, and we grew by some 11 or 12% or thereabouts. I don't have the exact numbers in front of me. So, it does affect our growth rate when the underlying growth rate becomes slow and sluggish. So, with 2 successive quarters of sluggish growth for the industry overall, I'm fairly optimistic that very soon, if not later, the growth for the industry will bounce back. And if the industry starts doing its traditional, 8-9% growth, it makes it a lot easier for us to achieve a 35-40% growth.
No, sir. Okay, let me clarify, sir. When you say 4Q is expected to be better, I mean, at least even if I look at standalone or console, your sales growth also is moving up. And if I look at 4Q expectations from or, commentary from the other players, they seem to suggest Jan was weak and they are not very, the confidence on 4Q is relatively lower. So that is why I thought that maybe, what you are doing is actually resulting in a far sharper divergence, and divergence will actually rise as we go forward. Is where I was thinking, but maybe am I right in that understanding is what I wanted to say.
Partly right and partly wrong in the sense that it is not totally independent of the industry. Now, if people have told you that January was somewhat weak, it was fairly decent for us. It was not outlandish. So if it was weak for others, then I can understand as to why, our outperformance would have probably continued in January. But, if others will grow at 3 to 4, then I think we can't hope to do much more than 20-25.
No.
If others grow at 8 to 9, that means the market is buoyant and it makes it easier for us to go to 35 to 40%. That's what I'm saying. So the outperformance is as a consequence of what we are doing internally, but the baseline is a consequence of what the market sentiments are, which are really not only beyond our control, but very difficult to predict. Market conditions are known to change very suddenly in the paint sector, sometimes in the positive and sometimes in the negative direction. And they happen miraculously across the country in almost 1 week. And I've never been able to understand why that happens. But historically, that's how markets change. And let's just hope for the best. That's all we can say.
No, fair enough, sir. No, I understood the equation, sir. It's very clear. So the second bit I wanted to understand was more, on the new player entry. Now, barring the near term, because we all will, there will be an action, we will obviously respond. But if I look at it more from a 2-year or a 3-year perspective, this industry has been fairly rational in terms of the way it looks at pricing, the way it looks at the consumer. Are you in any way worried that might change given, the new player is coming from outside the industry? And your thoughts on this would be very useful, sir.
No, I don't think that the rational behavior that you alluded to is likely to suddenly become irrational. The new entrant that you are talking about is also known to be a very rational player in whichever sectors it operates. And therefore, we would not expect a conservative, solid player like Grasim to come up with anything irrational. First of all, coming up with irrational pricing is likely to hurt a new entrant more than help them. And I do not expect a group with such solid foundations to behave in an irrational manner. Nor do I expect the industry to respond in an irrational manner because despite all the hype that exists in media and amongst analysts about the threat of a new entrant, I don't think the existing players within the paint industry are overly worried about it. And the reason is that everyone knows the huge barriers to entry that exist in that sector and the time it takes to circumvent those barriers. Now, nobody is saying that the new entrant will not succeed or will succeed partially or something. All we are saying is that the time taken to overcome all the barriers that is required is considerable. And therefore, it's not a 2-year or a 3-year period. You more talk about a 7-8-year period for any player with whatever might it may have to make a very meaningful mark as far as the sector is concerned. And if in that time period that company were to grow and become a significant player, and that is entirely possible, the industry growth would have been sufficient that none of the existing players, either top line growth or bottom line growth, would be impacted in any measurable manner. And therefore, I don't see any concern within the industry as far as the new entrant is concerned. All new entrants are welcome. They will keep the existing players on their toes. Competition is always welcome. And that's all that there is to it.
Okay, sir. Fair enough. That's very, very helpful. So just one bookkeeping, if I may. You pointed towards premium salience being lower. Is there a number you could share for us? Like where does it stand in terms of percentage? And how does it work, contrast to the industry?
But see, what happens is that qualitatively, as far as the premium end of the paints are concerned, the market share of the market leader would be disproportionately high as far as that segment is concerned. As you go down the steps, when you come to the number 2 player, their share in the premium segment would be probably the second highest, and probably, a slightly lower contribution from the overall pie coming from them. And as you move down to the smaller and smaller players, the share of premium paints that we sell as a percentage of the overall pie does get smaller. So to that extent, we are somewhat less impacted when a price drop is announced as far as the premium segment is concerned. Conversely, if a price drop is announced for the economy range, we would be affected far more by that in case we feel that we are not able to cover it by reduced spends as far as schemes for the dealers are concerned.
Got it, sir. Thank you very much. That's all from my side. I'll come back in the queue for the question. Thank you very much.
Thank you. The next question is from the line